Hi, this is a summary of accounting for stock options. When we account for stock options, we must first figure out the value of them, and they're determined at the grant date. We use a recognized formula to determine the value, often the Black-Scholes option pricing model. It's estimated, and it considers some of these factors: the exercise price, expected term of the option, market price, dividends, risk-free rate of return, and importantly, the volatility of the stock. Then we record as the compensation expense the value of those stock options that were awarded at the grant date, and we spread that out over the service period, which is usually the time until the vesting occurs. And it's pretty straightforward that way. Let's take a look at an example here. January 1, 2027, Universal Communications grants 10 million options to key executives. The options permit recipients to acquire 10 million of the company's $1 par common shares within the next 8 years, but not before December 31, 2030, the vesting date. The exercise price of is the market price of the shares on the date of the grant, which is $35 per share. The fair value of the options, estimated by an appropriate option pricing model, is $8 per option. First thing we're going to do is we're going to compute the total compensation, and that's going to be the 10 million options at the fair value per option. We're not going to recognize that at the date of the grant, but we're going to spread it out over the service period. So we have no entry at the beginning on January 1st of 2027. But then we're going to take that, because it's going to occur over 2027, 28, 29, and 30, and we're going to divide it by 4, and we're going to have 20 million per year. And so we have this entry: debit compensation expense and credit paid in capital for stock options, 20 million. This is just a check. Here they granted 30,000 stock options to executives. And importantly, the fair value of the options is $5 on the grant date. So we take the 30,000, we don't care so much about the par value or when they can be exercised. All we're figuring out is the total compensation expense here. And it's 30,000 times 5, $150,000. Now, look at the period between the grant date and the date that they can earliest exercise them. That is usually the service period: 27, 28, and all of 29, 3 years. So we figured $150,000 is the total compensation over the 3 years, and that's going to give us 50,000 per year. 150,000 divided by 3 is 50,000. Now, let's talk about forfeitures of stock-based compensation. Companies can choose whether they want to estimate the forfeitures, which is the more common approach, or to wait until they actually occur, which is less common. But when they do this, they have to choose an approach and stick with it, and disclose which approach they are using. Let's just give a simple, straightforward approach of estimating forfeitures. The same example that we had before, where we had 10 million options and the price fair value per option is $8. So that's 80 million over 27, 28, 29, and 30, 4 years. 80 million over 4 years would be 20 million each year, except that we're expecting a forfeiture rate of 5%. That is, we're going to take 80 million times 95%, that is 1 minus the 5%, and that's going to give us 76 million divided by 4, and we'll have a 19 million in the first year, debit compensation expense and credit paid in capital for stock options. And again for the second year, 2028. Now what happens if in the third year, Universal revises its estimate of forfeitures from 5 to 10%. Now our total compensation is going to be 80 million times 90%, and that's going to be 72 million. And by the end of the third year, we should have recognized 3/4 of that. That is 72 million times 3/4, which is 54 million. We have already recognized 38 million, and so the difference, 54 minus 38 that we've already recognized, is going to be 16 million. And that's going to be a debit to compensation expense and a credit to paid in capital stock options. Then in the last year, we just take the remainder, which is all of this, and that's 72 million, the total, minus what we've taken so far, 38 plus 16 is 54. 72 minus 54 is 18 million. And that's the expense in the last year. I will note that this approach is different from what we're going to deal with later when we talk about most accounting changes. This is just for estimated forfeitures of stock options. Now, as I said earlier, it is acceptable to account for revisions only as they occur. So let's go back to the same example, and we're not going to estimate them. We're just going to recognize the first year, 2027, is 20 million. The second year, 20 million. And then we actually have options with a fair value of 8 million when they were granted or forfeited due to the employee left. They didn't want to stick around. And so we now have a total compensation of 80 million minus 72. And I'm sorry, we have total compensation at 80 million minus 8, or 72 million. And if we are 3/4 of the way down that route, it should total up to 54 million. So if we take 80 minus 8 is 72 times 3/4, that because 3 of the 4 years have gone by, that's 54 million, minus the 20 from the first year, minus the 20 from the second year that we've already taken, means that we need only an additional 14 million in year 3 to catch up and to where we should be by the end of the third year. In the fourth year, we still have the same 18 million because we have caught up, and that's the way it should have been for 72 million all the way. If we had known it was going to be 72 million all the time, it would have been 18, 18, 18, and 18 in each of the 4 years. Now, what happens when the options are actually exercised? And this is what happens when half of the shares are exercised on July 11th of 2031, after they become exercisable. So we're going to get 5 million times the exercise price of 35, and that's going to give us 175 million. And that's the part that's cash. It comes from investors, that is the employees or investors in this case. And then we had this paid in capital that we've been crediting in all of these other entries over here. We've been crediting paid in capital, and we credited paid in capital for a total of 80 million, but only half of them are exercised. So we're going to debit paid in capital stock options for 40 million because it's only half of the 80 million that has actually been recognized in the stockholders' equity section as paid in capital for stock options. It's no longer paid in capital for stock options for those 40 million, so we're going to debit it. Credit common stock at the par value, And the difference between the total of the cash and the sweat equity, this is the sweat equity, the 40 million that the employee put in there. So it's 215 million minus the 5 is 210 million additional paid in capital or paid in capital in excess of par. Finally, what happens when unexercised options just expire? Usually this happens when the employee sits on those options and then thinking they might be in the money someday, and then they don't ever become in the money. In that case, we're going to let's assume that the other half, the other 5 million options expired without being exercised. Then we're going to debit paid in capital for the remaining 40 million, the other half, and credit paid in capital expiration of stock options, which is essentially a permanent contribution to stockholders' equity. Finally, to summarize, there are two broad types of stock-based compensation: stock and options. The stock can be in the form of actual stock or restricted stock units. The goal here is to recognize expense in the period of the related services based on the fair value at the grant date. Generally, we estimate a forfeiture rate and build this into the amortized compensation cost. However, it is possible to recognize forfeitures only when the employee departs. Making sure that stockholders' equity is correct. And that means that we just wait until it occurs, until the departure occurs.